Ladies and gentlemen, this is your captain speaking. Welcome aboard the Financial Independence Podcast. G'day, and welcome to another episode of Captain Fi, the Financial Independence Podcast, where I open the cockpit to some of the best and brightest in personal finance, as well as those who have reached or are on their way to financial independence. Before we get started, remember, nothing said here is financial advice, and you should always do your own independent research before making any financial choices. With that being said, I hope you enjoy the episode and learn something new. On board today is Pat Garrett, co-founder and CEO of Sixpark Online Asset Management. Pat's a financial advisor and a member of the FPA, as well as a graduate of the Australian Institute of Company Directors. He's worked as a board member, CEO, CFO, senior level corporate advisor, and a private equity investor. Pat's got over 30 years experience in the finance industry, having worked for JP Morgan in New York and San Francisco before moving to Melbourne, where he worked as the managing director for private investment firm Georgica Associates. In 2014, he co-founded Sixpark with Brian Watson AO, who himself also worked at JP Morgan as the chairman of JP Morgan Australia. So Pat's a pretty experienced and serious investor, but outside of work, he loves surfing, barbecuing, and spending time at home with the family and his dog Charlie. I've been in touch with Pat for a little bit now, and he's always made time to chat with me and answer any questions or concerns I've had, not just about my 5-figure Sixpark balance, but also about investing, mindset, and life in general. He's even taught me a few new recipes he's learned in lockdown. So, Pat, thanks for making time and welcome to the show.
Lucky, I've been looking forward to this for a while. Thanks very much. It's great to chat.
Awesome. So for the viewers who haven't heard of you or Sixpark before, can you tell us a little bit about yourself?
Yeah, sure. I moved to Australia about 20 years ago for what I thought was going to be 1 or 2 years. But after uni, I worked in New York City at JP Morgan for about 10 years, the tail end of which I was fortunate to work in the private equity division of the bank, which was being run by a gentleman named Brian Watson, who was a very senior and accomplished executive. Brian's actually originally from South Melbourne, and he eventually moved back to Australia with his family, and I followed over to have a bit of work and fun over here for a couple of years, and that was 20 years ago. We had always thought about creating a business, building a business, launching a business ourselves, but we needed the right idea that resonated with us personally, and Sixpark ended up being that idea. I'm thrilled about that because it's been an incredible journey. So originally from the US, been here for about 20 years. Love Australia, get back to the States, although not in the last couple of years. And as you said, I don't mind getting in the ocean and attempting to surf or going for a run along the coast.
Attempting to surf, that's what I do as well, Pat. The last time I went, I got absolutely dumped down at Nobby's Beach in Newcastle, and I think I gave myself a concussion. I haven't gone back in since, but hey, summer's just around the corner, so hopefully we're getting into some good weather for it.
Yeah, I think everybody could use getting in the water, and I've got a few scars on my head from a few kook maneuvers out there as well.
So you kind of alluded to it before. I wanted to ask, why did you start up Sixpark, and what were the problems you had seen with traditional investing or equity management?
Yeah, I think the seed for the idea was probably, in my mind, in 1997. My father passed away, and he had a portfolio of a small number of sort of blue chip U.S. stocks he had inherited. And my dad was a salesman. He sold law books for a living. And those investments were important in that they helped fund our education. But when he passed away, all of a sudden, my mom needed those assets and relied on those assets for her annual living expenses. So it wasn't necessarily a good setup after dad passed away that mom had a limited number of shares and she relied on them for her annual expenses. So there was very little diversification. All of a sudden, effectively, the risk dimension of that portfolio changed quite dramatically. So I went through the process of assessing and reconfiguring that investment portfolio. Even though I'd had 10 years of experience and reasonably fluent in the investment markets and asset management and finance, I found it incredibly hard and stressful. This is 97, so ETFs were popular, not as popular as they are now. So basically what I ended up doing, and it took a bit of time, was building a diversified portfolio of ETFs so I could feel comfortable that risk dimension was right and income level was right, and I wouldn't worry every night about whether one or two stocks went up or down. I remember thinking to myself at the time, if it was hard for me to do that, how hard is it for somebody that hasn't had formal training and all this stuff? So that was sort of a spark in my mind, because I then did the same with other family members where it was appropriate. To 2014 in Australia, and with Brian, who was on the board of guardians for the Future Fund, effectively providing asset allocation guidance for the country, it was really obvious, both personally with friends and professionally, that there was a massive problem in the market and that people couldn't really access professionalized investment management. It was too expensive, it was too confusing, and just too hard for most people to get that help. And I think the whole industry knew that, but nobody was doing anything about it. There's a lot to unpack there, but the financial institutions were pretty happy making money the way they were and didn't really want to change anything. So what we wanted to do, and I say we, meaning Brian, the co-founder, with myself, given we had asset management sort of in our DNA, so to speak, was basically build a technology platform, because ETFs at that point were growing, and this is significantly in Australia, was build a technology and digital platform that enabled people not just to transact, because that's effectively a commodity, and we're seeing that now today, but to actually provide advice, to actually help people and recommend an asset allocation using ETFs. That was the problem. And that was the reason we constructed Six Park. It resonated really personally, given that backdrop. It's been probably the hardest thing and most rewarding thing, at times scariest thing I've ever done. But that started in 2014, and we launched into the public sphere in 2016.
It's a really interesting point you hit on, Pat, about feeling anxious and maybe a little bit scared about investing.
Yeah.
I can remember feeling those exact emotions when I was getting started on my investing journey.
Yeah.
And we're probably at a time now where potentially new investors could feel nervous about investing. We're constantly seeing headlines about market crash imminent and market at all-time highs. What does that mean? And is now a good time to start investing?
Well, the price of admission for owning shares is volatility. And that's why over time, history would show that if you're patient, you'll generate a reasonably good risk-adjusted return by being invested in the market. It's an important comment over time, in that if you're investing for the medium to long term, so call it 5 or 10 years or more, I genuinely don't think there's a bad time to get invested in the market if you have money sitting around on the sidelines. People were talking 3, 6, 9 months ago about wait, because things are about to fall. Timing the market generally is a bit of a challenge. So I would say if somebody has a medium to long-term outlook, that I could think of as many reasons why near term there's optimism about where the markets are headed as there are reasons why it might crash tomorrow. Who would have thought that in the wake of some challenging or potentially scary inflation numbers, markets last night would have gone up over 1% on optimism about earnings and employment in the US? It's just way too hard to figure this stuff out in the very short term. The main answer is history would show that trying to time the market is incredibly difficult. So if you have a reasonable time horizon, I think the best time to get invested is now.
I'm really glad you brought that up, because it's all about that time horizon. I found personally when I first started investing, I sort of didn't really know what I was doing. I sort of muddled my way along and tried to do the best I could. And I got to a point where I felt confident in ETFs and listed investment companies. And so I was pretty much aggressively, almost 100% shares for a long time. And during the COVID crash, I did see a huge drawdown. My portfolio went down by 30% or something.
Yeah, it's
pretty
scary.
much I was terrified. I was saying to myself, I'm this big, strong investor. I've got guts. I'm just going to buy the dip if it happens. And as it turned out, I was actually spooked, and I sort of held off and held a bit of cash. And once the market started recovering, I started investing into them a little bit more. So that kind of taught me a little bit about risk tolerance. What I've been exploring more recently are ways to diversify my investments. and obviously Six Park being one of them. I probably should explain just quickly for everyone. Six Park is a diversified online investment portfolio. I think I transferred you guys to start off with a chunk, I think it's about $10,000, and you invested that according to my risk tolerance. And It's quite funny. I think when I did your survey, I might have answered how I wanted to invest rather than how I truly invest. So I'm going to be going through and doing the annual updates and trying to be a bit more honest with myself.
Yeah.
In my portfolio, I'm on the high aggressive growth.
Yeah.
In that, I've got some Vanguard emerging markets, global listed property, Australian equities, international equities hedged, international equities unhedged, global infrastructure, and bond fixed income. So there's quite a lot of different asset classes included in that, rather than just, as I had done before, the straight ETFs. One of the things that's probably different between Six Park and a couple of the other online investment advisors is that you specifically don't have gold in your portfolio. This is one of the main topics I wanted to talk about with you today, Pat, which was what's your opinion on and strategies on gold? And then, of course, we've got inverted commas digital gold being Bitcoin. So I'd love to hear your thoughts on that. With that, I actually did buy a little bit of gold today. So
diversification's incredibly important. So I think that's fine. That's great.
I know we were chatting offline before about the reason why I bought the gold was more about learning and experimenting. Why doesn't Six Park have gold in their portfolios?
Thank you for clarifying what Six Park does. I was remiss in not doing that earlier. What we effectively do is ask clients questions about risk appetite, risk capacity, time horizon, and experience in the markets. And we have effectively an algorithm. It's very similar to what you would be asked if you went into a financial advisor's office and asked for investment advice, and then drop you into one of several portfolios that have up to 8 different ETFs representing 8 different asset classes across growth and defensive asset classes. So in simple terms, the riskier you suggest you want the funds that you invest via the Six Park platform, the more will be weighted into the growth assets. And the more conservative, so we've got a lot of clients approaching retirement, and they don't want to have as risky a portfolio. So they'll have more weighted towards bonds and cash yield and those asset classes. We have an investment committee, which is chaired by Brian, my co-founder, who has experience with the Future Fund, but also Lindsay Tanner, the ex-finance minister, and Mark Nicholson, who was the co-chief investment officer of the investment division of the World Bank. And when we set up Six Park, one of the things we wanted to be a bit different and we thought was unique was that we're a technology-led company, obviously, and that we deliver our service online. But we've got investment asset management DNA. If you automate investment management but don't have the right inputs, to state the obvious, you can get not great outcomes. So we're really careful about reviewing asset allocations, the ETF landscape, global economic conditions, et cetera. And we're fortunate with that investment committee. And we did spend a bit of time when we were setting up the business thinking about gold as an asset class. I don't think gold is a bad investment. It has attributes of diversifying portfolios. And what I've seen and our investment committee has seen is typically hedge funds using gold, for example, tactically when they think maybe a crisis is imminent or certain market conditions might be on the horizon. We look at the super funds and we look at multi-asset class funds across Australia and internationally, and we really don't see gold frequently in there. And there's a reason for that, in our view. The main one being it doesn't generate income, as I think most people would probably know. And when I hear gold referred to as a defensive asset class, I bristle a little bit because I think a defensive asset class generates income. And a defensive asset class is also relatively low volatility, and gold is not necessarily a low volatile asset. Without going into the technicalities, as far as gold sort of being a hedge against inflation, I think the data's not entirely clear on that, particularly more recently. So you don't generate an income with gold. It has its windows of time when it performs pretty well. And that happened right around the COVID time. But if you look at it over 5 and 10 year periods, this all depends on start and end date. You can have times when it performs reasonably well in terms of price and only price appreciation because there is no income. But it can also have 10-year windows of time where the price is flat and there's no income during that period. So our view is that if you're a medium to long-term investor, what we would prefer, let's say if you're going to have a 10% allocation to a portfolio to gold, we'd prefer to take that 10% and put some of that into a growth asset class and some of it into a defensive asset class, both of which generate income and both of which the risk reward volatility parameters are pretty well understood. And so gold will be useful for some periods of time, and then for the rest of time, effectively a drag on portfolio performance. If you think of when gold performed really well during and around the onset of the pandemic, and since has sold off a bit, it was a great outcome on paper, but then once gold pulled back, it was a less great outcome on paper, and you didn't make income during the ride. So that's a long way of saying we just think that on balance, over the long term, it's a drag on performance, is our view.
Yeah, and so for those in the financial independence or the FIRE community who do have that long term, your understanding is it's probably not super relevant for us.
Yeah, correct. I think for those seeking what I understand to be the attributes of the financial independence and the ability to retire early or to dial down the work early, so to speak, I just think time is the power of compounding interest. I probably don't need to go into great detail on it other than to say I think people understand how powerful that is. I just think that should be a component of anyone's portfolio, and a non-income generating asset, it just really is a tough one on that part. Like you mentioned earlier, I don't think owning gold is a bad idea. We just prefer not to have it in our portfolios.
Okay, so it's all basically tailored to the risk of the investor and the time frame. Yeah, you obviously have different tiers, different portfolios for different risk appetites in Six Park.
Yeah. So we've got portfolios ranging from conservative to aggressive growth, which, as you might guess, have heavier or less heavy weightings on growth assets. And clients also have the ability to basically tick a sustainable option. So if you've got the balanced growth portfolio, for example, you can get the equivalent, but swapping out ETFs where we can with sustainable or ESG equivalent ETFs. So we try to keep it fairly simple. I think one of the things the investment management industry is probably not done great looking backwards is overcomplicate things. And to put the cynic's hat on it, is to confuse people so that they don't really know what they're paying fees for and they assume that they're getting some value out of that. So in terms of the landscape of investment management, I think simpler is a lot better, especially over time. And the same would be true for the DIY investors.
Yes, simple is better. I couldn't agree with you more, Pat. So having said that, what is your opinion on the traditional managed funds, LICs, ETFs, and the emergence of, I don't know if it's a new marketing term, but I only recently heard this, the active ETFs, which to me sounded like a bit of a contradiction, but there you go. What do you think of these new
I thought you were going to say it sounds like a bit of good marketing, which I think isn't a bad approach. Managed funds, I think you mentioned first. In short, I think active investing is very difficult. The data, the Standard & Poor's SPIVA report, just Google SPIVA, SPIVA. The data is really not debatable. When you look at actively managed funds, a vast majority fail to outperform their index after fees. And so there are some managed funds that have performed well over time, but very few do that consistently. In fact, a bit of a generalization, but it has happened repeatedly that funds that maybe perform really well for a couple of years, either through skill or luck, people then pile money in and they underperform. That is an incredibly common dynamic. So I think managed funds have a shrinking life ahead of them, to be honest, except for the asset managers that do it really well and can show that they deserve to get paid to do that. There's just not many of them. LICs are interesting in that they're similar to ETFs, but they tend to also have a bit of an active management overlay and fewer underlying investments within the fund construct. So a little bit less diversification, a little bit more of that active overlay. So there were some issues with them as far as who was getting paid to distribute them certain ways was a bit of a mess. So I just think plain vanilla ETFs are the most effective portfolio tool for investors. The active ETFs, or there's another one which probably falls into what you're talking about, which is thematic ETFs. Well, on active ETFs, I agree. I think the concept of active ETFs is sort of like putting a more active filter across an index. What it does is it does a couple of things. It reduces the transparency of exactly, I think, what the underlying holdings are and how that index will perform. I think they're more marketing products than anything because people got enamored with ETFs and how easy they are to trade and be well diversified. And product manufacturers, for the most part, have just tried to continue to feed the beast, so to speak. I think it sounds a little better than maybe reality as far as having like some programmatic filter that figures out which stocks are going to do better than than others. If it were that easy, this would have been done years ago. So I think some will outperform and some will definitely not. And a couple of years ago, yield ETFs were popular because people were yield hunting with low interest rates. And some of them were fairly spectacular failures in that they were using active filters to include companies that on paper had high yields. But part of the reason for that was the underlying company share price was weak. So that seemed like it had a high yield. And there was a reason why the underlying share price was weak. So what happened was you were on paper kind of getting a high yield, but the capital appreciation was really weak because the fundamental business wasn't great. So the total return actually was not very inspiring. But on paper, it sounded great. Massive yield ETF.
Yeah, and some of my friends have been burnt by that in the past.
Yeah.
I mentioned I was a bit muddled when I first started investing, and I was following a couple of stock picking and stock tipping subscriptions. I fell into that yield trap as well. I bought certain companies thinking they had a great income from dividends, and then the share price went down, and I realized, hang on, I'm being taxed on income from these dividends, but I don't get to claim any tax deduction for my capital loss until I sell it. So I just felt like I was getting screwed. I had a mate who did similar yield hunting with banks and basically came to that same realization that the ETFs was the simplest way to do it.
Yeah, I think we're big fans of hub, spoke, or core satellite because whilst I think what Six Park solves an enormous part of the problems that most investors have in terms of getting diversified and keeping fees low and letting some really experienced people do the heavy lifting for you and the technology in terms of like rebalancing portfolios, people want to have a punt here and there, or somebody might have a particular exposure to an industry because of work or life or whatever reason and say, I kind of want to back that industry, or I believe in this theme. I don't think there's anything wrong with that. That's active participation in managing your money. And it's awesome. I just don't think it should be all your investable assets. So the hub, spoke, core satellite, whatever you want to call it, that idea is a majority of your investable assets around something that's fairly simple, straightforward, and based in fact and data and history and a proven methodology. And then you can play around the edges of that.
Yeah, I think that's a very sensible commentary. And I sort of do a similar thing. I have some active investments myself, just basically having a play. So, Pat, as a licensed financial advisor and someone who's got decades and decades of experience in finance and CEO of a 100 million plus company, what do you think of influencers and financial bloggers like myself? Do you see these as a net positive, or do you see it as potentially a bit risky for readers that are maybe blindly following them? Or what's your take on the situation?
Well, I can't say it's a bad thing when I'm talking to you, can I? No, I'm kidding. I'm kidding. I think the answer, and I feel very strongly about this, is on net, I think it's a very positive thing. But like anything in the world of advice, particularly now that the digital landscape and social media has just opened the doors to the kind of stuff that's being delivered to people, you just need to be really careful about how you consume it as a prospective or existing investor. And in Australia, the number of financial advisors has gone from about 28,000 to close to 19,000 because of increased regulation and basically a shakeout of the industry. So the number of licensed individuals to help people with their investments has gone down significantly. Interest rates are low, housing affordability is low. So the need for people to get some help on the way they invest, and let's even step back before then, how they get out of debt, how people think about preparing a budget, how they work towards spending less than they earn, what to do when you start saving, all that stuff. I think the world of influencer, call it unlicensed commentators on financial matters or whatever the right term is, I think those that are doing it well add a tremendous service. I know of, and Six Park has partnered with several, and hopefully we'll be working with you shortly. And we're very careful on who we work with on that front, because whoever we work with, for example, is a kind of an extension of our service. But I think there's some really, really good people out there who are genuinely posting content and guidance as opposed to advice that helps people understand financial wellness, investment matters, and how to be better engaged and in control with their overall financial wellness. That's a great thing. With that comes murky waters where people will take advantage of that. I've gone into some of the chat rooms, and it's frightening, some of the stuff I read. I just think people should really consider the sources. If you're following, listening, taking on board content from somebody, assume that they're like a financial advisor. Do your homework on their background and make your own judgment call on whether you think that their guidance is sensible.
Yeah. It's funny you mentioned that about the chat rooms. One of my favorite things I like to do is there's a podcast called Equity Mates, and they're quite good.
It's
and
great.
They do a post, I think it's like the weekly finance fails or the monthly finance fails. They jump on TikTok and they get like the most ridiculous financial commentary and just the crappiest advice that people are giving. And it never ceases to give me a laugh. But, one of the most prominent influences, and you probably hate me using that term, that shaped my financial journey was Mr. Money Moustache, who Canadian, but I think he lives in America, in Colorado. One of your
one of my compatriots,
compatriots. And he was incredible for me learning about the mindset shift. And then there's a couple of really great ones here in Australia as well. And I guess this might be a bit of a loaded question now, Pat, but we talked about the power of ETFs and the power of keeping it simple. We've seen some new products come out in terms of the diversified ETFs. Say, for example, Vanguard and BetaShares now have products which are groups of their ETFs to try and give investors an appropriate risk tolerance. Why would someone benefit from using SixPark over, say, just buying the Vanguard High Growth Fund or similar?
Yeah, it's a really good question, and we get asked that a lot, and there's a couple basic baseline answers to it. First of all, BetaShares, Vanguard, we use their ETFs. We think they're great companies. Otherwise, we wouldn't use their ETFs. But when they put together a multi-asset class portfolio of ETFs, they almost by definition are only going to use their ETFs in doing that. One of the values of our investment committee is assessing the ETF landscape and choosing what we believe to be the best ETFs for portfolio construction. That's why we have 5 different ETF providers across the 8 ETFs that we use. So I think being product agnostic is one benefit. The other is we actually provide advice. And for the ETF providers that have multi-asset class ETFs, you might get it right in choosing which one you think is right for you. And if you've got a 40-year horizon and you pick up a high growth one from one of the providers, you're probably right for the moment. But people's life situations change over time. Certainly when the pandemic hit, somebody that maybe had a 30-year horizon with their investments, but then lost a source of income and a variety of other things happened, your risk profile changes. With SixPark, you have the ability to retake an assessment at any time. If appropriate, we'll modify our advice to you in terms of portfolio construction. With the products you mentioned, they're very good, but you're driving the bus, so to speak, whereas we help you drive the bus.
I guess you're essentially getting that guidance from SixPark, whereas you don't get that when you DIY.
Correct.
Yeah,
Correct.
I just wanted to bring that up as part of the question of the finfluencer topic, because often we see people looking to the finfluencers to drive the bus who may not be the finance professionals.
Yeah, it's a really important point because you mentioned when we started talking a little bit about the finfluencer dynamic, licensed versus unlicensed. And you're right, for the most part, they're not licensed. And so the government's actually and the regulators spending a lot of time thinking about how to manage or not the activities of those providing financial commentary online. And I think they're finding it a little bit of a challenge because they don't necessarily want to stop it, because I think they share my view that for the most part, it's helping people. I think 10% of investing is probably smarts and 90% is emotions. We talked about that earlier. When I see people like yourself, Victoria Devine, She's on the Money, Brandon at New Money, and others that we've spoken with, one of my filters is, are these people helping or hurting the education of people around the emotional dimension of investing, and mainly how it's detrimental to let emotions get the better of you? I just think that is one of the most important investing lessons. You referred to it earlier. I get nervous when the markets start crapping themselves. It's just natural. And what a history of information and data shows is that emotional decisions when it comes to money typically are not good decisions. So I just think the good finfluencers are teaching people about the basics like that, as opposed to get into crypto or don't get into crypto. And telling your journeys like you do and others do is great because it gives people a bit of a template to look at. But I think the behavioral side is one of the biggest areas where people get value out of folks like yourself.
Yeah, it's almost that trying to set a bit of an example to say, like, it's okay to spend less than you earn and invest the difference. And I find a lot of people do reach out to me, and it comes down to more that behavioral side. And I'm always happy to chat and help people where I can. But I think you bang on the money there, Pat. It's definitely 90% behavior and emotions.
Yeah.
So we talked about earlier, obviously the value that Six Park provides is the guidance and driving the bus. We've heard a lot about yourself, and obviously you've got a lot of credentials in the finance industry, as well as your other co-founder. So who is on the Six Park Investment Committee, and what are their views at the moment?
Our investment committee is chaired by my co-founder, Brian Watson, who was the chairman of JP Morgan Australia for a while and was one of the founding members of the board of guardians of the Australian Future Fund, the Sovereign Wealth Fund. Mark Nicholson, who was the co-chief investment officer of the World Bank Investment Division, and Lindsay Tanner, the ex-finance minister. And their mandate is to oversee and recommend to Six Park the parameters of our investment strategy. So that's mainly asset allocation and ETF selection. And commensurate with the asset allocation comes reviewing markets on a regular basis. They meet every 2 months, if not more frequently, if unusual things are happening in the markets. And I really want to record the meetings and share them publicly because it's a wholesale level of rigor and analysis. We've built our own mean variance optimizer to help us assess asset allocations and inform investment decisions. One of the most gratifying things about what we do, from my perspective, is provide that level of investment guidance to somebody with a couple $1,000s just starting their investment journey. I think that's pretty cool. And their view of the markets right now, there's certainly some concern. What happens with the emergence out of this pandemic and the pace of that? What happens with inflation? What happens with China and the policy that we're seeing out of the government? They're all risks. And certainly if one wanted to say, is the market overvalued or undervalued, you'd probably say it's pretty fairly priced. But they don't see any need at the moment to be changing any parameters of our investment portfolios, because when you have a situation where virtually every central bank in the world is saying we're going to support markets and prevent a meltdown, that's a pretty big tailwind for markets. And earnings have been solid, and admittedly it's on the heels of pandemic level earnings. But companies have a lot of cash. There's obviously been a shakeout of some that have fared well and some fared less well. But on balance, earnings and growth trajectories for corporate America, which is the biggest economy in the market in the world, are reasonably solid. So I think there's definitely some concerns. And as we talked about a bit earlier, markets are volatile. Markets in Australia, the ASX goes down one every 3.5 years over the course of a calendar year. So down years, it happens. So at some point, markets will exhale. That's just a given. That's what they do. Yeah. Will that be a traumatic event, or will it be just an orderly correction? I don't know. Will that be in 2 weeks or 12 months? We don't know yet. Nobody really knows that. I guess cutting to the chase a little bit, we still have a generally positive outlook, though it's a relatively short horizon because there's just a lot of unknowns. But as many, if not more, positives than there are negatives.
And as you said earlier, if we zoom out and take a long-term horizon, we know that the benefit that you take for that volatility is good long-term growth.
Yeah.
Yeah. Thanks so much for talking about investing in Six Park today. I just want to switch lanes a little bit and chat a little bit more about yourself and your career, if that's okay.
Sure. Happy to.
Yeah, awesome. First up, you've had a pretty successful and awesome career in finance. Is there anything you wish you knew before you started?
It's a good question. I don't like to look back and think shoulda, woulda, coulda too much. But I guess early in my career, I actually have an engineering degree with a minor in commerce out of the University of Virginia in the States. And I went up to New York not knowing exactly what I wanted to do. When you look at a resume, it looks like everything's neat and orderly in somebody's trajectory in life. I had no idea what I wanted to do. I had an engineering degree. And I was lucky to get a role in the operations department, like internal management consulting at JP Morgan, and then meander my way across to corporate finance and then into private equity. I'll just be candid about it. I had massive insecurities when I was in the early stages of that journey because I didn't really know what I wanted to do. And I was having a great time in New York, but it's pretty frenetic pace. I guess if there was something I was going to just be candid and honest about that I knew of then was to worry less. I worried a lot. If anything, I am a perfectionist at times. And so early in my career, I had a phenomenally great time in New York, but I did worry a lot. And as my role increased and responsibilities increased, so did the stress and anxiety. So I guess if there was anything I knew or could tell myself is to enjoy the ride more and don't worry so much and just back yourself. I did learn that over time. Otherwise, I wouldn't have had a crack at starting a business. That's probably what I would tell myself and tell others out there who are early in their career. Learn, absorb, work for good people, be observant of the positive attributes you see in people out there. Back yourself and don't stress too much. We live in a really stressful world right now. I think there's an imperative to figure out how to not get caught up too much in all the noise.
Yeah, I love it. You can't control the waves, but we can learn how to surf them, right?
Yeah, exactly. Yeah, I love it.
Yeah. So we've talked a bit about investing, but what's your personal investing preference? Which portfolio does Pat's investing timeline align to?
I took the 6-part assessment and it dropped me into balanced. So that's where I am. And I'm very happy with that because I'm guessing a little older than some of the people that will be listening to this. That's a good question on the heels of what I just said, because I'm genuinely at a stage in my life where I don't want to worry too much if and when the markets get wobbly, and a balanced portfolio is 60% allocated to growth assets. There's certainly a growth dimension to what I'm invested in, but also a bit of defensive cover so that I can sleep well at night. In terms of my kind of investment strategy, generally speaking, I really draw back to that example of what happened when my dad passed away and I had to set up an investment strategy for my mom. And that was a real eye-opener for me. And I learned the benefit of having an investment plan, how diversification is a form of risk management, and how being patient over time pays enormous dividends, literally and figuratively, because markets do over time recover. I think there's a great stat that we've used in a blog where I think if you have a 1-year investment horizon, the chance of you losing money in shares is some number up 25%. If you have a 5-year horizon, it's 10%. I'm not getting the numbers exactly right. But if you have something like a 10-year horizon, it's actually 0%. If you've been invested in share markets over a 10-year horizon, there are no windows where you would have lost money from start to finish. So my preference is to set up a portfolio that has the right risk dimension for me and just let it do its thing so I can focus on things in life that I get a bit more fun out of.
Well said, Pat. Now, look, this wouldn't be the Captain 5 podcast if I didn't finish with these 2 questions.
Yeah.
We've talked quite a lot about this next one throughout the whole episode, but if we could summarize them into 3 quick points, what would be your top 3 financial tips for someone on the path to financial independence?
Well, one would be start early. I think that's just a no-brainer, given the power of time in the markets. I have the equivalent of a self-managed super fund in the States from the time at JP Morgan. I hadn't looked at it literally probably 10 years. And I looked at it and it had gone up a fair bit, which was great. And it was mainly because of time. So start early, spend time on a budget so that you're living within your means. And if you can make regular contributions over time, that just turbocharges that time dimension of starting early. And then the other thing I think is one of the most valuable lessons any investor at any stage could learn is that concept of controlling your emotions. Because if you've got a great plan and you're saving early and doing all sorts of stuff the right way, but you panic at the wrong time, you can lose it all.
Yeah, behavior is super important.
Yep.
Okay, last question, Pax. Who or what has been some of the most influential people, experiences, or books on your financial journey?
Good question. The honest answer, the people would be our investment committee, which I've now had 7 years of exposure to. And I feel it's a privilege to sit in a room every 2 months with Lindsay, Brian, and Mark, and before Mark, Paul Nicholson, who unfortunately passed away, but he was the founding general manager of the Future Fund. Their insights and views of the world and economic conditions and financial markets, I have been absolutely fascinated with for 7 years and have learned a great deal. I feel super privileged to be able to have exposure to that on a regular basis. So I would say those are the people. And in particular, Brian, who I worked for in New York starting in the mid-90s, has been a phenomenal mentor for me my whole life. In terms of the experiences, I'm going back to it again, but that drill of when my father passed away and I had to reconfigure the investments, that was baptism by fire, even though I was steeped in theory and financial institution land. That was an experience that taught me everything I needed to know about investments through an unfortunate incident, but having to do it myself.
Yeah, a bit of a trial by fire and obviously a really, really difficult situation, but you've come out of the other end a lot stronger.
Yeah.
Look, Pat, again, thank you so much for your time this
Pleasure.
morning.
I've really looked forward to this and I've really enjoyed it.
I'm so grateful to be able to have you on the show and share your knowledge with all of the listeners. I'm sure everyone's taken away a lot of really, really good points. And if people want to get in touch with you or Six Park, what's the best way for them to find yourself or the company?
Just go to their website, www.sixpark.com.au. There's heaps of information in there on how the service works, who the people are, the different features and functionalities, the costs, everything. It's meant to be transparent and intuitive. So just go have a look there. And there's multiple ways to get in contact with myself and the team on the website.
Awesome. I'll leave links in the show notes to the website as well as to stuff we've discussed on the episode today. So again, thanks so much, Pat. Really, really grateful for your time. Go and smash this next meeting. And
thanks, Lucky.
Look forward to borders opening up, mate, so I can come down and we can maybe go and have a surf. Yeah, awesome.
Sounds great.
Right. Cheers, mate. Bye.
Bye.
Thanks for listening to another episode of the Captain Fi Financial Independence Podcast. To read the transcript or check out the show notes, head over to www.captainfi.com for all the details. If you have a question for the captain, make sure to get in touch. You might even make it on the airwaves. You can reach me online through the Captain Fi contact form or get in touch through the socials. I'm active on Facebook and Instagram, as well as a number of online finance and investing forums. And finally, remember, the information presented on the show and the links provided are for general information purposes only. They should not be taken as constituting professional financial advice. You should always do your own research when making any financial decisions and make sure it's appropriate for your personal circumstance.